Now let's discuss what is the difference between fixed and flexible exchange rate regimes. Very simply, a nation's choice as to which currency regime to follow reflects national priorities about all facets of economy, including the inflation, unemployment, interest rate levels, trade balances, and economic growth. In later videos, we shall discuss the relationship between inflation and exchange rate, how inflation affects the exchange rate, and how interest rates affects the exchange rates, the effect of trade balances on the exchange rate, and balance of economic growth in terms of GDP on the exchange rates of exchange rate of the country. So the countries would prefer a fixed rate regime for the following reasons. For example, due to the stability in international prices, because there is no change in the exchange rate, so the prices would remain stable. And it is inherited with the anti-inflationary nature. So due to these two main reasons, company would prefer to maintain a fixed rate, rate of exchange of its currency. But it has the following drawbacks. For example, need of central bank to maintain large quantities of hard currency and gold to defend the fixed rates. Like in China, China tried to fix the value of Chinese yuan in terms of the gold, and as a result, the Chinese central bank started printing yuan to maintain the supply of Chinese yuan, and started taking dollars back in exchange, and from these dollars Chinese central bank started buying US treasuries and the corporate bonds, etc. And this is a long story. So to maintain a fixed exchange rate, the central bank needs needs large quantities of hard currencies in order to defend that exchange rate, and the fixed rate can be maintained at rates that are inconsistent with economic fundamentals, like the parity theories. We shall discuss these theories, the parity theories, and their relationship with the exchange rate in the later videos. So what are the attributes of ideal currency? So ideal currency possesses the three attributes which is commonly referred as Impossible Trinity. Why it is called as Impossible Trinity? Let's take a look. The three attributes of ideal currency includes the exchange rate stability and full financial integration and monetary independence. Let's take a look at a diagram. Here, this exhibit explains the relationship between the three attributes of the ideal currency. Here one is exchange rate stability, means the exchange rate should not fluctuate widely over a given time period. And full financial integration means that country also wants a free flow of capital. And monetary independence, that monetary policy or monetary authorities should, or the exchange rate should be independent from the monetary system. So it is called as Impossible Trinity. Why it is called as an Impossible Trinity? Because a country cannot achieve these three objectives or these three qualities of currency at a time. For example, if country wants to maintain a fixed exchange rate and also wants a free movement of capital, its monetary authorities or the central bank is required to maintain the fixed exchange rate by controlling the supply and demand of the currency, like I've given the example of China. On the other side, if country wants the free flow of capital and also wants that that monetary authorities should not intervene, then it would be impossible for that country to maintain the fixed exchange rate. So this is an impossible trinity. If you want to achieve the two objectives, you have to give up the third one. So the country has to select any two of the three objectives or the three qualities of the currency which it can achieve at one time. A country cannot achieve the three objectives at the same time. So this is known as the Impossible Trinity. So let's talk about the birth of the European currency. How the European currency euro emerged. In December 1991, members of European Union met at Netherlands to finalize a treaty that changed Europeans' currency future. This treaty set out a timetable and a plan to replace all individual European currencies with a single currency called the euro. And a time frame was basically given to achieve certain objectives if a country wanted to become the part of this eurozone. So for that country who wanted to join this euro currency required to maintain a certain level of nominal inflation rate and the long-term interest rate and the fiscal deficit and the government banks. So what was the benefit of this euro currency to the European zone or the European countries? This was the cheaper transaction cost in eurozone because the European Union countries, not all, one important thing here is that not all European Union countries joined the eurozone. For example, few of them like UK and like Sweden and UK and Sweden did not join the eurozone, and Denmark as well. So the benefit to those countries who joined eurozone was the cheaper transaction cost, and the currency risk and the cost related to uncertainty are reduced, and all consumers and business both inside and outside the eurozone enjoyed price transparency and increased price based competition. So these were the benefit of introduction of euro currency. One important thing here is that the traditional European currency should not be mixed with the euro currency. Euro currencies is a term. It is a term used for the domestic currency of one country on deposit in the bank of the second currency. So the euro currency market serves two valuable purposes. One is the euro deposit are an efficient and convenient money market device for holding excess corporate liquidity, and euro currency market is a major source of short-term bank loans to finance corporate working capital needs. So basically the euro currency is every domestic currency deposited outside its home country. For example, if dollars are deposited outside US, these dollars are known as euro dollars. So if pounds are deposited outside UK, you can say that these are euro pounds, and so on. So European currency euro should not be mixed with the euro currency. So there's a difference between euro and the euro currency. So this is the end of a quick review of lesson 2. Thank you for watching.